I have made a ton of money investing entirely passively in real estate, and I want you to be able to do that too. But I've also made some mistakes. So I have learned that there are 5 things you have to get right if you want to be ultra successful in passive investing. So I've put them all together for you, and I'm going to share it with you right now. So let's jump into it. First of all, if you don't know me, I'm Maria Zondervan, and I started my career as a wildlife biologist, saving endangered species. Very different than anything I do today. But I'm also now a real estate investment advisor because while I was a wildlife biologist, I was also investing in real estate. So I've been doing this since 1996. And now I help people allocate their capital into passive investment deals, but I don't work for the deal sponsors, I work for the investors. And I own a real estate portfolio worth millions of dollars, but I also invest passively, meaning no landlording, no tenants, no swinging hammers, just I put in the capital and I become part owner in that usually apartment complex. That's what I like to invest in, but I've also invested in a hotel. And I just get a share of the profits as one of the owners, right? So I've done that in 7 different states plus Puerto Rico so far, and looking to do a whole lot more. So I've learned quite a bit while I've been doing that. I'm also a business owner. I own 2 massage envy clinics with my husband, and that means we have a tax problem, right? When you make a lot of money as a business owner, you tend to get a lot of taxes, and real estate really helps offset that. So that's another reason we make sure we're investing passively in those. And I do invest in every property that I suggest other people invest to, or I bring to them as an opportunity for investing in. And I'm a busy mom, 2 boys, one with autism. They keep me hopping. So here's the family. And yeah, all right. So that's a little bit about me. So now, the first thing you have to understand, the first thing you must get right is, what do you want? Because different investments offer different things. So you have to understand what your goals are. You have to define what's right for you. So do you want income now or long term? Are you looking for immediate cash flow? That's going to be a very different investment than building growth for the future. Are you okay with money being tied up for 3 to 7 years? Or is this something where you need to keep liquidity? Very different investments. Are you investing for retirement? You want to make sure you have a good life after a certain amount of years working. Or are you investing for legacy, for your child, for your grandchildren? I am investing heavily to make sure my autistic son is going to be okay beyond me, right? Or is it more for lifestyle? You just want to improve how you live this life and just make it the best it can be. Again, those are going to be different. Or do you have perhaps a tax situation like I do with my business, where you want some real estate depreciation to write off those taxes? All of these things can happen, but they're going to be different investments. There's no one size checks all these boxes, right? No one size fits all kind of things. So that's the first thing. That's kind of a bonus. Now we'll get into the 5 main things you must get right. First of all, the deal sponsor. So this is the person or the team, usually it's a team of people that put together the whole deal, right? So sometimes they're called operating partners, general partners, syndicators, sponsors, but basically they're the person that has found the deal, they're putting it together, and then they're inviting you to become a limited partner, meaning you're going to be a passive investor in the deal and partake in the profits of that deal, right? So they're going to do all the analysis, they're going to contribute their own money to earnest money deposits and due diligence costs, all of that kind of stuff. And they're going to get compensated by fees and equity within the deal. So that's a sponsor, and you want to make sure they know what they're doing, because if they don't, your whole deal could tank, right? So you want to ask them, how many assets do you have under management? You want to make sure they're not brand new into this. And of those, how many have gone full cycle, meaning they've purchased it, managed it, and exits, and what was the result of that? Did they make the types of returns they were promising? If they promised their investors 15%, did they get close to 15%? More? Less? How much? Have they had any capital calls? So this means after you've already invested, they come back to you and say, hey, we need a little bit more because this, that, or the other thing, unanticipated expenses. If so, how did that work out? Did their investors trust them, give them a little bit more money, and then in the end, did they end up recuperating all the money they put in plus make the returns? Or did it not go according to plan, right? So you want to know what's their team structure, and are they vertically integrated? Meaning, is everything in-house? Do they do property management in-house? Do they do construction in-house? Do they well, all of it, basically? Or do they have third-party property managers, third-party construction, in addition to their acquisition team, right? So there are different ways of structuring this, but the more they have in-house, generally, the safer your investment's going to be because they have more control. And then what's their communication style? Are you the type of person that really worries about your investments and you want to hear from somebody at least once a month? Then you want to see if they have monthly reporting. Most of them have quarterly reporting. Some only report once every 6 months. That might make you very uncomfortable. So you just want to see what that's like. And what else about their communication? Can you call them at any time and ask what's going on, ask for an update? Or is it strictly you'll get something by email every now and then? You might want to know that, especially for your first deal, right? And then alignment. Do they invest too? Most do, but it might be varying levels. Some may not. So you should know. The second thing you want to get right is the market that you're investing in. Don't assume that hot markets are always the best. Your goals will dictate this, right? So if you are looking, for example, for cash flow right now, then you don't want to be in a hot market, because in a hot market, the property's going to be asking for premium prices, right? Which is going to constrain cash flow, because they know the property is going to increase in value and you'll have a very strong exit. So that's more of an investment for the future. If you want cash flow now, you don't want to be in a market that's sinking, or people are moving out of there, but maybe something that's more stable, not quite so hot, or a secondary or tertiary market. You're going to be able to buy things there at a lower price point, allowing you to cash flow better. So it's more of a cash flow play. But when you exit, you probably won't get as much for the deal as when you first bought it. Or well, hopefully more than that, but you're not going to get as big of an exit as you would in a hot market, is what I meant to say there. So, okay, so you want to look at the whole metropolitan statistical area. You want to look at things like population growth, job diversity and stability, supply and demand, of course, cap rate trends. Okay, so cap rates is basically just a measure of what things are going for. So the lower the cap rate, the more expensive things are, and the higher, the less expensive it is. So again, that feeds back into those hot markets. The cap rate might be very compressed, might be around a 4 or 5%. That means it's going to be pretty darn expensive to buy there, versus a second or tertiary market might be 6, 7, maybe even 8% cap, and that's going to lead to a lower purchase price. Okay, but it also affects your exit price. So you need to take a look at that. And then look at your sub-market and the local areas. You don't just want to look at the whole thing, right? So I live in Orlando, Florida. If I'm buying in one part of Orlando, it's not going to be the same as another place. Orlando's really spread out. So I want to look at the whole area overall, make sure it's doing well. But then I want to look at my sub-area. So that's going to matter too. You want to look at things like crime rate, affordability. You don't want to have an apartment complex that's charging $2,000 a month rent if the population there could only afford $1,500, for example, all right? You want to look at schools if the asset you're investing in has a lot of 2, 3 bedroom places, right? If they're all 1 bedroom places, it's less likely to have kids, then it might not matter so much. And you want to look at transportation. All right, so third thing, the business plan. So this is, what are they actually going to do with this property? Are they just buying it and it's going to keep operating however it was before, or do they have something more in mind? So what's the strategy there? Value add tends to be very popular. This is when you buy something that hasn't been renovated in a long time. Maybe it was built in the 80s and they haven't done anything. And so if you go in and you freshen it all up and bring it up to today's standards, you can charge a lot more rent. And apartment complexes in particular are valued, well, all commercial real estate really is valued based on what the income of that property is. So if you drive up the rent or reduce the cost of the place, because after you renovate everything, you have a lot less repairs, right? So you drive down your expenses and you increase your income, that net operating income is going to be much higher. And so your evaluation when you go to sell this is going to be much higher. So a lot of people like doing those value adds, but it does come with some construction risk, right? So you have to understand how that's going to affect your cash flow, because you're going to put money into the property first before you start getting money out. Is it stabilized and cash flowing? at purchase, right? So are you buying something that's so decrepit that there's only like 50% of the units full? Or are you coming into something that's already very nice and 90% or so occupied, very stable, and you're just going to make it better? So one isn't necessarily better than the other. Again, it depends on what your strategy is, but make sure you understand it and that it aligns with your goals. New construction. Some people like it because when it goes well, the returns can be really high. You take ground, which didn't cost very much, you put a brand new building on it, so you're paying construction prices, and then usually they fill it up, stabilize it, and sell it immediately. Sometimes it's pre-sold, so as soon as the building goes up, it's going to exit, and you can make really good returns. But it's a bit risky because there's no cash flow when you first buy it, right? It's just raw land, and you're buying into the future value, and it can be hard to predict. So yeah, it's a little riskier, but the returns can be really great. Is the underwriting conservative? So the underwriting is all the projections, all the math behind it, really. So there, you're going to be looking at what's doing now and what are you projecting it to do in the future. Is it conservative? Is it realistic? Because sometimes it's pie in the sky. They think, well, the rent's going to increase 10% a year and you're never going to have any vacancies and there won't be any unexpected expenses and all that kind of stuff. So look at that underwriting and make sure it makes sense. All right. And you want to stress test it for things like the rent. What happens if the rent doesn't come in as high as you hoped it would be? Are you in trouble? Can you still pay the debt, the mortgage, right? What's the occupancy like? What's the cap rate? If you're buying it at a 5 cap, are you hoping to exit at a 4 or 6 or right where you were? Like, are you being conservative? So look at those kind of things. And what's the expense ratio? How much of the income is going back out to expenses? When I'm looking at conservative underwriting, I expect that number to be somewhere between 45 and 55%. Now, when you've owned something a long time, it might get down into the low 40s or even high 30s, especially if it's a newer asset class, but that's not going to happen when you first buy it. So you want to make sure that at least in the underwriting, that it's being conservative. Assume that you don't know what else is going on with this property and there could be hidden expenses waiting there. So be conservative on that. So you want to look at the expense ratio. When is capital return and how's the loan structured? This is important to know, right? So there are different ways in business plans that they can do this. They could just say, hey, you're going to invest in this property and your money's going to be in there until it's resold. And we're going to sell this property in, say, 7 years. And then you'll get your capital back plus a return on that investment. And, of course, cash flow in between. But in other cases, they might say, okay, we're going to hold this property for a while, but in year 4, say, we're going to refinance it because by then the value will be much higher. And when we refinance, we're going to give you back your capital, whatever you invested. But you'll still be an owner, so you'll continue to get cash flow until we sell. And then when it sells, you're going to get the sales proceeds as well. So there's different ways that they can do that. There's cost to refinancing, so it doesn't always make sense to do it. But you need to understand what the business plan is, or if they're can just be looking at the market and see where they're at. But you need to be prepared for how long your money's going to be in the deal. So you need to have that basic understanding. And then you want to understand how returns are structured. What's your cut? How much of this are you getting? So this could be any number of ways. It could be that you just have a straight split. Maybe it's 50-50. Okay, whatever comes in, the general partners take 50% and the limited partners split the rest of the 50% based on how much they put in, okay? That would be unusual, but it might happen. Sometimes there's something called a preferred return, or maybe they'll say 6% preferred return or 7% preferred return. That means you're going to get 6% or 7% per year back on your money before the general partners get paid anything at all. And then there's a split after that. Maybe after that it goes to 50-50. More likely it's going to be somewhere like 60-40, 70-30, where the limited partners get the biggest share. So they'll get like 70% of all the proceeds after they've already got their preferred return before the general partners get anything. And the reason for that is you want to incentivize those general partners to really manage this asset well. All right. And you want to learn how to read the offering memorandum, the OM, and you want to watch sample offering webinars before investing. So I always have old deals, things we've done in the past on my website that people can watch and get an idea of how these deals are structured. So they're familiar with all the terminology and stuff before there's a live deal. So if they're excited about it, 'cause sometimes you just get wrapped up in the excitement, you might just jump at the first thing you see and you have nothing to compare it with. So I really recommend doing that. It's a great learning process without any of the pressure to invest, right? And of course you want to look at the property itself, but note it is number 4 on the list, and it's number 4 for a reason. This is less important than many of the other things we talked about. So the first thing is, what class of property is it? Is it A, B, C, or D is generally how that's referred to. And that's just a matter of how new and fancy is it. Okay, so Class A is going to be your newest and your fanciest properties. It was built just a few years ago. It has a gym and a pool and a dog park and all the fancy amenities, right? Maybe it's got a theater, who the heck knows? It's got all the latest gadgets. So it's going to be a Class A. Class B property is something that also has a lot of amenities, but maybe it's a bit older, okay? And then you could have a B plus, B minus, you know, things like that. Class C is more of your workforce housing, okay? So it's an apartment. You know, maybe it has a few little features, but it's basically it's just there for you to live in it. It's going to be comfortable, it's going to be fine, but it's not flashy. It's not flashy. And then Class D, those are older, very run down properties that might be in a worser part of town, maybe not quite as safe, maybe there's some crime areas there, right? So it's sort of a sliding scale. And you can make money in any of those, but it's going to affect what your business plan is and who your property manager is. They need to be familiar with that class of assets because they're going to be managed very differently. The size and the unit count. Of course, you want to know that. You want to know the renovation status, if there's any deferred maintenance, are they going in and replacing all the roofs, things like that. What's the tenant makeup, right? Are you looking at properties with families, or are they all studio apartments for students or single people or something like that? You want to look at the past performance, and you want to see, okay, is it realistic that we do better than that? Are they already managing as good as it can be, and you're just going to be continuing that on? You know, what that ties back to that business plan, right? You want to look at Google reviews. You can learn a lot from Google reviews. You know, I looked at one recently, and a bunch of the comments talked about a major roach problem in this place. Like, they had a serious pest control issue. And that's something you'd want to know, because unless you address that right away, you're going to have some terrible Google reviews, right? And then weather risks. Is it an area that's flood prone? That's going to make insurance go up and could cause other problems, hurricanes, earthquakes, okay? You're not going to be able to avoid everything there is, but you want to make sure you're well insured for those things. All right, so these are just some looks at some past properties that we have had investors come into and things that I have invested myself. So this is just kind of a look at what some of these properties might look like. And I just realized that I haven't been making my screen very large. Sorry about that, guys. So here you can see them a little bit different. So these are in all different parts of the country. So here's one in Jacksonville, Florida, one in Texas, and another one in Ohio. And they're all a little bit different, right? So those are just examples of some that they can be. So most of them are 100 units or so and up, because that's where you get the best economics deal-wise. So you usually want to structure them to be on the larger side. And okay, so last but not least, you want to look at your funding source. Yes, it matters where your money that you invest in comes from, okay? So you could invest with your savings account. You might have money sitting in a money market that's not paying very well. You could use those, or CDs, any of those things. Stock reallocations, if you'd rather have some stuff in real estate where you get more of those tax savings. Maybe you have some crypto, okay? But here's one that's often overlooked, is your retirement funds. Okay, so let's talk about the difference of investing in all those things at the beginning and then retirement funds. A lot of people don't even know you can invest in retirement funds, but you can if you do a self-directed thing. But on those first ones, that's cash in your pocket. So when you invest via those, you're going to be able to take advantage of all the tax benefits that come along with real estate investing. You'll get primarily depreciation, but expense write-offs, all sorts of things like that. When you invest in retirement accounts, you don't get that because they're already tax structured to save you a ton of taxes. So you could have a traditional IRA where no taxes are due until you start pulling money out of that account, or you could have a Roth where the taxes have already been paid. Now you can double your money every 4 to 6 years, like the plan is, through these real estate syndications, and never get taxed on the money that's coming out. But you do have to have that in a self-directed retirement account. So if you're unfamiliar with that, reach out to me. I'll help you figure out how you can do that. But it can be a self-directed IRA, solo 401k, EQRP. There are lots of options, but these are things that where you own that retirement account and you can do whatever you want to it. With those investments, you do not have to just do stock market kind of things. Very powerful ways. And some people forget that they have money sitting there that they could be investing, and it could be working much harder for you than it might in kind of the plan options, if you will. Some people will pull money out of a home that they own or investment property or take a line of credit. You can do that, but do it with great caution. Make sure you still have the money to pay the monthly payments on that. But it can make total sense. I mean, if your line of credit costs you 6% and you're going to be making 15 to 20% in this, it makes sense. But remember, the cash flow might not line up with when your payments are due, because a lot of these strategies, they make most of their money on the exit when they resell. So you have to make sure you can pay those lines of credit in between. So it can be a smart strategy because you're making money on money that isn't even yours. You're taking a loan out, right? So yeah, just be cautious and really talk to a CPA or financial advisor about that before you make a decision like that. And make sure you understand how the deal is cash flowing. For example, I mentioned preferred return. If it has a preferred return of 7% and you're borrowing money at 6%, you might say, well, I get 1% more than I have to pay, so I'm good. Well, that 7% return isn't guaranteed to be paid out every year. Maybe the first year they're doing heavy renovations and they're only paying out 3%, okay? They still owe you the 7%, but it will accumulate. So the next year they'll owe 7% plus whatever they didn't pay the first year, and so on and so forth. And in some deals, they'll accumulate all the way to the end, and all of that's caught up on the sale. So you have to make sure you understand the deal. So be cautious if you're using that sort of thing. What are some realistic return projections? So if you're familiar with the rule of 72, we're going to talk about that. So most of these deals are structured to try to double your money every 4 to 6 years. Yes, that's true. It can do that. So in order to do that, we need to have returns between 12 and 18%. So it's the yellow areas on these slides. And that is using the rule of 72. So if you're not familiar with that, we'll cover how that works. I guess it's not going to cover it there. I thought I had a slide on it, but basically you just take 72 and you divide it by the interest, the rate of return that you're expecting. And that tells you how many years it takes to double your money. So anytime you're looking at investments and you want to see, should I put money here or there? Oh, it's just 1 or 2 percentage points. Does it make that big difference? Look at this math. Huge difference, right? If it's a 1% return, it takes 72 years to double your money. 2%, it cuts it in half, 36 years, right? Up to 4, you're cutting it to 18%, or 18 years. So, it really matters. But once you get up to 12, now you're talking 6 years to double your money. Get up to 18%, you're talking about 4 years to double your money. Huge difference, right? So start thinking about that. How is it possible to get those types of returns? Well, we've kind of alluded to some of the value add and some of the things, but remember there's leverage being used here. The biggest partner in all these deals is the bank. The bank is bringing in usually between 65 and 80% of the money required to purchase that asset. So in the big scheme of things, the investors are actually putting in a very small amount. But the bank, they don't need 12 to 18%. They're usually happy with a much, much lower return than that. So you're not sharing profit with the bank. They're just getting a fixed interest rate. Okay? So there's a big lever there that's helping you get higher returns. So that's one thing. Then you have economies of scale. Just think about it. If you've ever flipped a house or renovated a house, if you need a new refrigerator, what do? You go to like Home Depot or Lowe's or something and you buy a refrigerator at retail prices. Well, you're not going to do that if you're doing an entire apartment complex. You got 100 plus units, you're going to buy wholesale at great discounts. Same thing, if you're paying someone to paint one unit versus come out and paint 100 units, the price per unit goes down. So you're operating at large scale, and that brings down the price of everything. Professional management, big difference, right? If you've ever self-managed or had a property manager that's managing a couple of rental units for you, it's not a big priority for them. They've got a bunch of clients, you got to be on them all the time. In this case, you're talking about professional on-site property management. Their only concern is that apartment complex, right? That's where they are. So very different. They're going to try to do everything in their power to keep your occupancy up and make the tenants happy because they have to deal with it every single day. And their income is directly tied to it. All right, let's talk real quickly about some of the benefits of being a passive investor. Obviously, it's a hands-off approach, right? You're not dealing with any of the tenants or the toilets. All you really have to do is review quarterly reports, and that's it, or monthly reports, or however they report. There's the potential for steady cash flow, again, depending on how it's structured. Those are kind of the equivalent of dividends, and they can produce regular distributions like that to the investors. You can diversify your investment portfolio very easily, right? You don't have to be in the area where you're investing. I'm here in Florida, but I invest in Ohio and Texas and all over the place, right? Because you're not doing the day-to-day time. And you can also invest in different types of asset classes. And huge tax advantages, whether you're investing in your retirement account or with cash, there's huge tax advantages in real estate. So remember, it's not just about what you make, it's what you ultimately take home that matters. And so really pay attention to the tax advantages here. So what are the next steps for you to learn to become a great passive investor? So first of all, get clear on your goals. Make sure you know why you're investing so you can select investments that line up with that. Identify some trusted sponsors. Connect with them, follow them, talk to them, right? Do all that kind of stuff. You can find them at meetups, you can find them at conferences, you can find them online, follow them, see what they're doing, and talk to those people. Get yourself educated. Go to webinars. Read over some offering memorandums of things like this, of those properties I showed you, right? When they put out those offerings, even if you have no desire to invest right now, start looking at them. Prepare your money. Make sure you know where you're going to be pulling your money when the right investment comes along, and ask lots of questions. And if there's a sponsor that doesn't like you asking questions, they're not someone you want to be investing with. So that's a good sign right there. Join investor clubs. We've got one with Blue Vikings Capital. We have one that's for our income fund and one for real estate syndications like this, but you can go to our website, bluevikingscapital.com, and sign up for that investor club. But there are lots of those out there, and that can help you get these offering memorandums. They can help you connect with sponsors and see deals as they come out, as well as look at past deals, right? And if you're overwhelmed, get guidance from a capital allocator like myself. Get the advice. It's free. Nobody charges to talk to you about these sorts of things, and there's never a pressure to invest in anything. We really are just there to guide you, and we never charge for those consultations. Nobody who's worth a darn would charge for that. So, and then once you get fully educated, you need to be ready to move when the deals come about. Once you find something that checks all those boxes for your goals, and this is what you've been looking for, because they're limited. All these deals, the bank brings most of the money. They're only looking to fill that part that's basically the down payment, and that will fill very quickly. So I've had a lot of people that when the deal hits, that's when they start learning the process, and they start reviewing everything and want to set up all the calls and stuff. And it's fine to set up a call and get your questions answered, but you shouldn't be in the learning process. You should learn before then, because you'll end up missing out. Some of them will fill in a day or two. Some might take a week or two. It just depends on how much they're raising, where it's at, how popular it is. But it will not be something that's going to be available for a month or something. Like I said, the best ones fill really quickly. So make sure you start doing that homework. And if I can help in another way, you can download this free book. And that will bring you through all the steps that I just talked about, and I'll have some other deep dive information and also tell you how you can connect with me further, which I'll show you how to do that anyway, but I'm just leaving this up here for a second so you have a chance to grab that or grab a screenshot. You can also find it on my website, thebluevikingscapital.com. All right, and here's how to connect with me. You're welcome to follow me on social media. You're welcome to set up a call and reach out to me, and I can help you personally. So with that, I thank you so much for your time and hope this has been of help. Please follow me to get more great strategies like this. Take care.